Hello, very good morning to all and happy Friday. I'm Kelvin here. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Friday, the 20th of December 2024, and it's 5 more days to Merry Christmas. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap first on what has taken shape yesterday in terms of the broad-based cross-asset intraday performance, the relevant news flow, and as well as economic data released from yesterday and stretching up to until today's early Asia session. So yesterday, let us focus on the FX market. So we know that the FX markets in the last few days, dollar has been strengthening pretty rapidly. So that actually came within our expectation as well for those who follow our daily dose of market insights. So I did explain in the last few sessions why dollar is strengthening is primarily driven by a potentially less dovish Fed policy in 2025 from a Fed pivot to a normalization pivot, and that has been cemented in yesterday's FOMC meeting conclusion after the release of the latest dot plot. So will not touch more about that. For those who miss out, the daily dose can take a look at yesterday's daily dose, which I really published in OANDA's Asia Pacific YouTube. So let's look at the performance of the dollar. Okay, so the dollar is actually strengthening pretty much against the other major currency, but I want to focus over here is later when I cover the intraday technical outlook. The dollar is now losing some steam against the Aussie dollar. That has really been highlighted on yesterday's technical intraday outlook on the Aussie dollar, looking for a potential bounce at the 62 figure level, which has been holding on. And later on, I'll touch about the Japanese yen, the dollar yen. So the dollar yen rallied yesterday to our resistance level, but right now it's showing some signs of Japan dollar strength setback against the Japanese yen. Why? Later I'll touch on. There's one fundamental factor that is driving this ongoing intraday dollar strength setback against the yen. But primary speaking, all the currencies actually, the European currencies rallying strongly against the the dollar is strengthening rapidly against the European currency like the euro and the sterling, and primary is the sterling dollar. Look at this sterling dollar here, this dark green. There was a swift rally of the dollar against the sterling. Why? Because of that dovish we call it monetary policy hole that's being detected by Bank of England. So for Bank of England, they hold interest rate as expected, no change, okay, at 4.75%, which is primarily much higher than the Fed. But why the pound actually weak against the dollar dramatically? So for those who follow our daily dose of market insight, we have been actually advocating for a weak sterling against the dollar in our intraday technical outlook, and yesterday's sterling dollar actually rallied to our first resistance before collapsing and print lower low. And the reason why is because of there are three central banks officials in Bank of England actually voted for a cut yesterday. So it's 6 versus 3, so it's about half 6 versus 3, whereas market participants is only forecasting one split, 8-1. That means only one officials to cut, but the outcome was there was actually a stronger voice in the community there's a stronger voice among the Bank of England officials. Instead of one of them voting for a cut, there are actually 3 of them voting for a cut. But net overall, they still put on hold. Why? Because there are more officials that are choosing to stand pat in yesterday's meeting. So this is considered as a dovish hold. So that actually causes the sterling dollar to actually collapse rapidly against the USD yesterday. That means we're talking about dollar strengthening because of this dovish hold that's been portrayed by the voting patterns of Bank of England officials, also indicating that because of this 6-3-1 vote over here. Okay, setting up the stage for next year of a much more potentially dovish Bank of England going forward next year. Okay, so that actually causes the market to be forward looking and sell down the sterling dollar against the US dollar yesterday. So I'll touch on more about the technicals of the sterling dollar thereafter. And looking for dollar yen. So dollar yen rallied as expected, hitting the bridging above the 155 156 plus level. So that has been also reinforced during yesterday's start of the European session. Why? Because Bank of Japan, Governor Yuda press conference actually took shape before the start of the European session at around 1:30 p.m. to 2 p.m. Singapore time. So it actually hindered the chance of a later rate hike. That means he's trying to actually talk down the chances of later rate hike. So I believe that the reason why doing that over here is because of the negative risk of scenario that has taken shape in Expo's FOMC meeting the day before, where we start to see a steep intraday sell-off in the major US stock indices, giving a bit of feedback loop into global stock market as well. So because of this so-called negative feedback loop driven by a less dovish Fed that's being implicated on the movement of risk asset using the S&P, the Nasdaq 100, the Dow Jones and Russell as a proxy of risk asset movement, that potentially causes Bank of Japan Yuda, in my opinion, to hold back or issue a rather lackluster, not so hawkish monetary policy guidance coming up from his press conference, indicating that the next BOJ hike may come after the after January. That means instead of early in January, it may push back to March. So what he did over here is that he opened up the possibility of waiting longer for his next interest rate hike in the comments, that lower the expectation of a January move and hammered the yen. That means that's why the dollar yen actually spike up over here. So based on his remark over here, he said that the overall picture on wages should be clearer by March or April, and that it may take time to assess the full impact of Trump's policy. All right. So what it means that over here is that the next BOJ rate hike may only come after the March or April annual wage negotiation between the unions and Japanese corporation. All right. So he tends to actually push back. We call it much later, instead of earlier. Market is anticipating a January hike, but now the January hike chances has been reduced greatly because of the latest remarks being made by Bank of Japan Governor Yuda in his press conference yesterday. He said he wanted to looking for a more firmer ground of wages growth before deciding the next monetary policy move. So that potentially could come in either March or April, where we have the conclusion of the annual wage negotiation between Japanese union and their respective corporation. All right, and now the reason why the dollar yen is selling off in today's Asia session while we are speaking over here, the dollar yen has really came back down slightly while we're speaking. Why? Because of a rather better than expected inflation data out from Japan. So we know that if inflation data continues to improve in Japan, there is actually better chances or the more encouraging factors or impulses for Bank of Japan to steppen up its normalization interest rate policy rather than keeping interest rate at this very low level, despite the hike 2 times in 2024, bringing it up from negative to zero, then thereafter to 825 basis point. So the core inflation in Japan actually rose from markets expecting 2.6%, it actually increased to 2.7% and above 2.3% that was printed in the previous month of October. So if you look at the trend of the core inflation rate, this is the nationwide one for Japan, not the Tokyo, the leading one that has already been published 2 weeks ago. So that already given a sign that nationwide Japanese inflation trend is slowly ticking on the upside. All right, so it actually rose by 2.7%. So this is actually the highest core rate increase in 3 months. So if you look at the 5-year trend, it's very clearly shaping a series of higher, lower. So doing what I call a basing formation, looking for a bullish breakout above the 2.8 year on year that is printed on the February 2024. So this is the, okay, Japan is very weird. They have core inflation rate as well. So what the Bank of Japan is looking at is the core inflation rate. That means they exclude food and energy. Okay, so if you look at the core inflation rate, they deem it as core inflation rate. If you open up the because core inflation rate only exclude it exclude energy, that doesn't exclude the food prices. So if you look at the core rate, also showing signs of improvement because it actually inch up 1 basis point higher from 2.3% year on year that was printed in the previous month of October. So if you look at the core inflation trend over here, where is it? Yeah, this core inflation. Okay, why it's not showing? Okay, core inflation. Eh? Yeah, CPI core. Yeah, this is the one. Okay, so it has been slowly inching up for 4 consecutive months since hitting a low of 1.9% year on year in July. So that was below Bank of Japan 2% target. So that actually created a panic then. But now the inflation trend in Japan has started to stabilize and starts to inch up much higher above that 2% long-term target that BOJ desired. So you look at the 5-year trend, very clearly it has started to turn around, a very clear turnaround after this deceleration that took shape for almost a year in 2023 all the way to July 2024, hitting a low of 1.9%, then thereafter slowly inching upwards to go above that 2% target, right, that Bank of Japan desired. So that actually explained to us why the dollar yen is selling off right now as we are speaking. Okay, later I'll touch on the technical outlook on the dollar yen for today, the intraday technical outlook, then the key levels to watch as well. Okay, now back to the major US stock indices. So the major US stock indices, for those who follow our daily dose of market insights, because of yesterday's exposed FOMC sell-off, we got to actually switch to a bearish bias, and this bearish bias potentially also highlight the start of a multi-week corrective decline, which I highlighted in yesterday's daily dose. And yesterday's price movement has been lackluster as well. Opened up the high for the S&P 500, but thereafter it closes at the low. Okay, a very weak intraday performance. Similar for the Nasdaq 100 as well, and as well as the Dow Jones Industrial Average. Open at the high, gap up, but thereafter can't maintain the momentum and sell off and close at the intraday low. So net overall, we see a lack of bullish momentum coming back into the intraday performance of the major US stock indices yesterday. So yes, despite the fact that the SPX is almost unchanged at negative 0.9%, but the way the price behave is rather bearish, not bullish. Open at a high, gap up, but couldn't maintain the momentum upon gapping up, then thereafter close at the low, right? The worst hit was the higher beta Nasdaq 100, down negative 0.46%. So if you look at the heat map of the S&P 500, for sure we know that the culprit is the mega cap cohort. All right, so if you look at the several mega cap cohort over here, okay, doesn't gel so well with Tesla down negative 0.9%. Okay, and Meta down negative 0.2%. Apple almost unchanged, 0.08%, despite Nvidia is up 1.37%, but the rest of the semiconductor stocks are in the red. All right, so I would say that it's a rather weak market breadth among the major mega cap grouping sector, the groups. All right, so now with that, let us now jump our focus now immediately to the intraday technical outlook on those various broad-based cross asset classes, starting with the FX market first. All right, so with that, let me expand my screen so that you guys could have a better view of the chart right over here. So let's start with the FX market. Right, so FX market start with the euro dollar first. So for the euro dollar, no change. Yesterday we expect a bounce, so the bounce hit our first resistance as desired before coming down, and because it didn't break below the exposed FOMC intraday low, that's this steep sell off, I do not want to tighten the short-term pivotal support for today at 1.0 43. That was yesterday's first resistance of that bounce. All right, so there's still a risk that it may test this bounce again before coming down. So still using the 1.046 level as my short-term pivotal resistance level, maintaining that intraday bearish bias on the euro dollar. Below 1.0330 exposes 1.29 figure next, followed by 1.02550, right? 1.0250. All right. So I repeat, I don't want to tighten the short-term pivotal support level. I don't want to tighten the short-term pivotal resistance too tight to the first resistance level that got rejected yesterday at 1.042 level, because it didn't actually break down below last because the exposed FOMC sell off intraday low over here. All right. Then because it may revisit 1.042 again for today, so I still leave the 1.046, 1.0460, still maintaining that short-term, that as a short-term pivotal resistance level, still maintaining that intraday bearish bias in any bounces. Breakdown below 1.0330 exposes 1.29 figure and 1.0250 next. Only a push up and an hourly close above 1.0460 will invalidate today's intraday bearish bias to see that bounce transforming into a minor mean reversion rebound, revisiting the 20-day moving average at 1.0516/1.0540. Next intermediate resistance above it exposes 1.06 resistance level, which is pretty key because that got rejected on 29th of November and 6th of December before kicking start this minor impulsive down move sequence on the euro dollar. Right now, what was the worst was the sterling dollar yesterday. So sterling dollar yesterday hit our resistance level, hit our short-term pivotal resistance level, which was 12675 yesterday, which is a 20-day moving average, before plunging very steeply. So this plunge over here was explained by that dovish whole monetary policy guidance, indirectly implied by the voting patterns among the Bank of England officials yesterday, which I highlighted earlier on at my start of my today's daily dose under the news flow segment. So I don't want to cover that in greater detail. So now the hourly RSI is at the oversold level. So now it may start to shape a bounce, taking shape over here. So this bounce level that we would look out for will be the former minor swing low of 19th of December, where previously it shaped that bounce yesterday. That came in your expectation. Then thereafter, that steep plunge took shape. So this should actually offer some form of important psychological implication towards the market, because it can't maintain that earlier bounce and the steep sell-off induced after breaking that 1.2570 level. So I'll be using 1.2570 level as my short-term pivotal resistance level in any chance of any bounce taking shape during the start of the European session, given that it's now at the oversold level on the hourly RSI. As long as this bounce didn't surpass 1.2570 with no hourly close above it, we shall maintain the intraday bearish bias on the sterling dollar. Next support level 1.2460/2450. A breakdown below it exposes 1.24 figure level, and if it can't hold in today's session at 1.24 figure level, it may see a further push down to expose 1.2320/1.23 figure level, which is a 2-time Fibo extension taken from the high of 6th of December, push it down to the low of 13th of December, project it up to 18th of December, and as well as if you were to go to the daily chart, this 1.23 figure level is a very clear medium-term swing low area of 22nd of April 2024. This V-shaped recovery previously there. All right, so with that, let me go to the hourly chart again. Only a push up with an hourly close above 1.2570 figure level, then today's minor bounce will start to transform into a mean reversion rebound, looking for a further push up to retest the 20-day moving average, acting as a resistance at 1.2675. Above it sees 1.2720/1.2780, which correspond to the downward sloping 50-day moving average. So that's for the sterling dollar. Turning our attention now will be the Asia Pacific currency, the major dollar pair against the Asia Pacific currency, starting with the dollar yen. So dollar yen actually pushed up as expected, hit the 157 figure level. So that was our resistance yesterday. And what's interesting over here is that this push up, the RSI has started to shape a bearish divergence. Right here, very clearly a bearish divergence, and now has really exited from the overbought level. So what it means that now the price action is trying to work out yesterday's steep movement up to do some form of normalization. That means, i.e., that could be potentially a minor pullback scenario taking shape to do some retracement of yesterday's steep rally, okay, induced by a less hawkish Bank of Japan. So the next resistance level to watch will be the 1.68 Fibo extension at the 15860 level. And graphically, if you go back over here, okay, is this minor swing high area of 16th of Jan as well. All right. So with that, I'll be using this short-term pivotal resistance zone, okay, 15835 slash 15880, flip to a intraday bearish bias for that minor pullback scenario to take shape, okay, over here. And if I were to do the Fibo retracement of this entire rally up from the low of 3rd of December all the way up to yesterday's today's Asia session intraday high 157.93, that is the 23% and the 38% Fibo retracement, and as well as the 50% Fibo retracement. So net first two support level to watch on the intraday basis will be at 155.85. A breakdown below here exposes 154.30. Unless it can't maintain at 154.30, then this retracement will ignite a much more steeper pullback, or shape a corrective, steeper corrective, minor corrective decline, exposing the next support level at 153.30 slash 152.70. That also correspond to the 20-day, the 50-day, and the 200-day moving average, all conferencing at this similar graphical support zone and converse with the 50% Fibo retracement level as well. So this zone here is rather important. Why? Because if the price action pull back towards this level here, potentially here may start to kickstart another leg of impulsive rebound sequence or movement. All right, but for now on the intraday basis, because of this bullish exhaustion has been depicted by the bearish divergence on the hourly RSI, potentially we may see a minor pullback scenario or retracement scenario in the first step taking shape, using 158.835 slash 158.80 as my short-term pivotal resistance. First two support level to watch on the intraday basis, 155.85 followed by 154.30. Only a push out and the hourly close above 158.80 will invalidate today's intraday bearish bias for that setback scenario to get totally damaged, and we will start to see the movement of that impulsive up move targeting the next resistance level at 159.45, followed by the all important 160.30. So 160.30 is in fact the very clear minor congestion area here of 27 on June and 8 of July before that sell-off take shape previously. All right, over here. So that sum up the dollar yen intraday technical outlook. All right, flipping to a intraday bearish bias below 158.35 slash 158.80. Now, what's up next for the Aussie dollar? So for the Aussie dollar, yesterday we flipped to a bullish bias looking for a bounce. So the bounce almost hit the resistance level at 62.85 slash 63 figure level. So still no change, still using the 62 figure level as my short-term pivotal support level, which confluencing with the lower limit of this medium-term descending channel that has been in place since the high of 30th of September this year. So using 62 figure level as my short-term pivotal support level over here, still maintaining that intraday bullish bias. First resistance level to watch, no change, 62.85 slash 63 figure level. Only a push up exposes 63.30. However, if price action start to shape a hourly breakdown with a close below a breakdown and an hourly close below 62 figure level, then today's intraday bounce scenario will be invalidated to kickstart another round of impulsive down move, exposing the next near-term support level in first step at 61.60 slash 61.20. All right, so that sum up the intraday technical outlook on the major dollar pair. Now, with that, let us focus our attention to the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 continues to remain flattish of congestion over here. Yesterday, during the US session, it attempted to break below the first support level at 16,600, but managed to hold above it, staging a bounce. And right now, during the Asia session, there's some we call it bearish movement coming in below the 19,960 short-term pivotal support resistance level. Pardon me, short-term pivotal resistance level. So still no change for sure. This is a very clear key short-term pivotal resistance level. So as long as this level is not surpassed to the upside, we will still maintain that intraday bearish bias on Hong Kong 33. First support level it got to break is the 19,600 level. A breakdown below 19,600 exposes the next near-term support at 19,337. Only a push-up and an hourly close above 19,600 will invalidate today's intraday bearish bias to see a push-up or a bounce in first step, exposing the next near-term resistance zone at 20,300, then followed by 20,520 next. Right, so still no change on the Hong Kong 33, using 19,960 as my short-term pivotal resistance level. Maintain that intraday bearish bias, but price action in order to see more impulsive movement towards the downside, equal to break below the first support level at 19,600. Right, so that's for the Hong Kong 33. Turning our attention will be the Japan 225. So Japan 225 shape that bounce expected, 39,923, then thereafter collapsing right now. Okay, there's a bearish reaction over here. So a bit of excess yesterday, so I'll use 480. So 39,230/480 as my short-term pivotal resistance zone. As long as this level is not surpassed, potentially the Nikkei 225 may shape a further push down. So today's first support level to watch out for will be the minor swing low area of exposed FOMC meeting, or at the start of yesterday Asia session at 38,315. Okay, only a breakdown below 38,315 exposes the next near-term support level at 37,990 next. All right. However, a price action push up and hourly close above the upper limit of today's short-term pivotal resistance zone, which is 39,480, will invalidate today's intraday bearish bias to see a movement to flirt back again at the upper limit of this sideways complex range configuration, 39,830, followed by the significant medium-term range resistance zone of 40,155/40,280. So if you go back in time, since September 27th of September, it has been evolving in this complex sideways range configuration with the upper limit or the medium-term resistance range resistance at 40,155/40,280. Right, so that's for the Nikkei 225, still maintaining that intraday bearish bias within this medium-term sideways range configuration, using 39,230/480 as my short-term pivotal resistance zone for today. Now, flipping our attention will be the European stock indices, German 30 or German DAX. So German 30 did not fare well as our expectation. Previously, we wanted to see a bounce at the 20-day moving average and also at the lower limit of this minor ascending channel that I drew from 19th of November. Yes, there was a minor bounce, but the minor bounce didn't have a follow through and hit the first resistance, and instead it tumbled down, breaking below the lower limit of that minor ascending channel support, and so breaking below the 20-day moving average. So the first resistance level to watch will be the 20-day moving average at the 19,960 level. I don't put it so tight here as my short-term pivotal resistance level. I use it slightly higher at 20,190 level. So as long as any bounce didn't surpass, so this is so very close to the pullback line of this former minor ascending channel support, now turns into a pullback resistance. Okay, pretty close level over here as well. So as long as this 20,190 short-term pivotal resistance is not surpassed, we will flip to a intraday bearish bias. Next support level to watch will be 19,690/590, which correspond to the 50-day moving average acting as a support level. A breakdown below it exposes the next near-term support at 19,445. Only a push-up above 20,190 will indicate yesterday's push down as a failure bearish breakdown to see a recovery, exposing the next near-term resistance level in first step at 20,360, followed by the all-time high area at 20,460. So given yesterday's negative price movement, like I explained earlier, on the German 30, we will be flipping to a bearish bias for today, using 20,190 as my short-term pivotal resistance level. Now, flipping our attention will be the major US stock indices, starting with the Dow Jones Industrial Average. So the Dow Jones Industrial Average of the US Wall Street 30 rallied as expected, hitting the first support, the first resistance level before tumbling down. So still no change. This came in our expectation. So yesterday we expect a bounce because of that steep sell-off exposed FOMC and exposed Jerome Powell, the Fed chairman press conference. So still using 42,930 as my short-term pivotal resistance level, maintaining that intraday bearish bias. Next support level to watch will be 41,840/41,590. So this level is also rather important from a medium-term perspective. Why? Because if you look at the daily chart over here, it corresponds very closely to the major ascending channel support from the low of 30th of October 2023. So only a push up and an hourly close above 42,930 short-term pivotal resistance level will invalidate today's intraday bearish bias to see a much more meaningful mean reversion rebound, capturing the next resistance at 43,325, followed by 43,720, which is close to the 50-day moving average, acting as a resistance, and as well as the former minor ascending channel support from the former medium-term ascending channel support from the low of 6th of August, turned into a pullback resistance at this zone of 43,325/43,720. Okay, so that's for the US Wall Street 30. Now, turning our attention will be the higher beta Nasdaq 100. So the higher beta Nasdaq 100 managed to get rejected at the 20-day moving average and also at our first bounce level. So still recall yesterday we expect a bounce. The bounce take shape and it collapsed as expected. So since that it now has managed to print a lower low, okay, very clearly this is a lower lower. Okay, this low, lower. So this will be my first resistance level to watch because the RSI is now also back to the oversold level already. So there could be some kind of bounce when the European session start. First bounce level to watch will be at 21,180 level over here. And with that, I will tighten my key short-term pivotal resistance because it print a lower low to 21,400. Okay, so this one I copy, paste. Okay, 21,400. Okay, so this will be the next resistance level. Okay, so as long as the bounce didn't surpass above the tightened short-term pivotal resistance on the Nasdaq 100 for today at 21,400, we will maintain the intraday bearish bias, looking for the next support to come in at 21,780/21,630 level, which is the congestion area here. A breakdown below 21,630 exposes this minor swing low area here of 15th of November and 19th of November, which is the graphical support of 20,335 right over here. Okay, only a push up an hourly close above the tightened short-term pivotal resistance at 21,400 will invalidate today's intraday bearish bias to kickstart a kind of a mean reversion rebound, exposing the next resistance level at 21,600, followed by 21,890. Okay, so that's sum up the intraday technical outlook on the major stock indices. Now, let us turn our focus to the commodity market, starting with gold XAU/USD. So for gold XAU/USD, we expect a minor bounce to take shape, and the bounce yesterday take shape, almost hit the first resistance before coming down and shaping this kind of sideways movement over here. So the hourly RSI, very interestingly, continues to print a series of higher low, okay, indicating that the bounce may not have ended over here because of this series of very clear higher low on the RSI. So with that, still no change, still using that 2,577, which is our short-term pivotal support level yesterday, still maintaining that bullish bias for that minor bounce scenario to continue to play out. First resistance level to watch will be 2,631. Only a breakout above 2,631 exposes the next resistance at 2,658. All right, so for gold XAU/USD, it seems to be evolving in this kind of sideways range configuration on a intraday basis. However, if the price action starts to break down with an hourly close below 2,577, will invalidate today's intraday bullish bias for that minor bounce to play out to flip to a bearish stance on gold XAU/USD, floating downwards in intraday, exposing the next near-term support level at 2,560, followed by 2,537. All right, so net overall still using 2,577 to maintain the intraday bullish bias for this potential minor bounce scenario to play out. Why? Because of the positive element that's been displayed by the hourly RSI, continuous two series of higher low over here. Okay, so that's for gold XAU/USD. Now, lastly will be the West Texas crude oil. So West Texas crude oil, we were neutral yesterday between 17.94 and 69.30. But what's interesting over here is that the hourly RSI has managed to break down a parallel ascending trendline support after flashing out a lower low. Okay, there's a lower high over here, whereas price action show a similar higher. So what we could do over here is that this is a bearish divergence. We will flip to a intraday bearish bias right now because of this bearish divergence. 70.90 short-term pivotal resistance level, a breakdown below 69.30 exposes 67.85. Max, if this level can't hold, it will expose the 67 figure level, which is the minor swing low of 18th of November and 9th of December. Only a push up and hourly close above 70.94 will invalidate today's intraday bearish bias to see a push up towards 71.70, followed by the key medium term range resistance of 73.15, which has been capping previous boost from breaking out since 24th of October. So that's close to about 2 months already. So this is considered as a medium term range resistance at 73.15. All right, so that sum up the intraday technical outlook on the broad-based cross asset classes as well. So before we go, let's have a quick look at the calendar. What are the key data to look out for today? So let me have a quick refresh over here. So so what I could see over here is that in China at 9:15 a.m. The loan prime rate for both the 1 year and 5 year remains unchanged at 3.1% and 3.6%. And during the European session, one thing that is important data that could impact the movement of the sterling dollar will be retail sales number out from UK at 3 p.m. Singapore time. And thereafter it will be a rather quiet session. That very importantly will be the US core PCE inflation data that's out at 9:30 p.m. Singapore time. So market will be focusing on the core PCE data. Market is expecting a slight uptick to 2.9% year on year from 2.8%. So if you look at the trend of the core PCE price index over here, in fact it has been slowly plateauing in the last 3 months. Okay, give me a minute. Yes. So it has been plateauing since July, August, September, and October. There's a uptick. So it seems to me that there's a V-shaped movement. So you look at the 5-year trend, notice it seems to be turning around a corner like a U shape like this. So market is expecting today is at 2.9%. So if it starts to came above 2.9% at 3% and 3.1% over here, very clearly it seems to me that it has started to form a U-turn on the upside U-turn. So that also could imply that the US Federal Reserve fears are pretty much we call it in line because of higher risk of inflationary pressure coming into the US economy next year. So when if the core PCE inflation data coming at 3% to 3.1%, that could ignite another round of dollar strength coming back into the picture, and potentially also will start to see a further weakness, intraday weakness on the major US stock indices with those key levels, bearing in mind that I share with you all on the Nasdaq 100 and as well as the Dow Jones Industrial, i.e. the US Wall Street index or the US Wall Street 30 in the short-term intraday technical outlook, which I highlighted earlier on yesterday. Okay, then with that, let us take a look at the calendar again. What are the things to look out for? So yes, that's about it. In the weekend, there is no key data to look up. All right. So with that, that sum up today's intraday. That sum up today's daily dose of market insight. I wish you all a very great, happy Friday, a restful and wonderful weekend, and we shall speak again on next Monday. Thank you.